Ryan in Texas is in the 32% tax bracket. Where should he save for retirement so he'll be in a lower bracket? Should Veronica in Texas pay the taxes now to convert to Roth for lifetime tax-free growth in the future, even though she is in the 37% tax bracket? And Jerry in Phoenix wonders if there is any point at which Joe would come to the conclusion that Roth conversions no longer make sense. That's today on Your Money, Your Wealth podcast number 535. First up, a word of Roth conversion thanks from Al in Florida. I'm executive producer Andy Last in Everlovin Adelaide with the hosts of Your Money, Your Wealth, Joe Anderson CFP, still in Minnesota as you watch or listen, and currently not thinking about YMYW at all in Greece, Big Al Clopine CPA.
All right, let's go to Big Al. He's your brother in Florida.
Apparently, yeah.
Just want to thank you guys. During the market plunge, either Big Al or Joe recommended to use market drop to do Roth conversions. I did. And with the market recovery, I have recaptured 30% of the taxes I paid.
How about that?
Boom. I would not have thought of doing that. Thanks again.
Yeah, that's a good strategy that I think a lot of people don't necessarily think about. So it's simply this. So the market declines, and instead of freaking out, look at the opportunities that you have. One opportunity that you have is consider the money in your IRA 401k. Can you convert it to a Roth IRA? Because whatever you convert, whatever it's worth when you convert it, that's what you pay taxes on. And if the market's down, you're going to pay lower taxes, and let that market recover while it's in a Roth IRA, and that future growth is tax-free.
Yeah, he cut a check to pay the tax, and all of a sudden he looks a month later. It's like, well, wait a minute. I just recovered everything that I paid in tax.
I'm caught up. Yeah, look at that.
I broke even. Right? So, yeah, I think there's so many different strategies that you need to be thinking about in regards to like how you're managing your assets. I think when people think about asset management, they think about the asset allocation. Right? How much money should I have in stocks and bonds, and what stocks should I buy, or what bonds should I buy, and should I get in alternatives? Yeah, of course, all of that is important. But I think what's more important is how you react to certain markets. If you have a strategy on managing the risk, such as when markets go up or down, that you're constantly selling high and buying low. Or what are you doing from a tax management perspective, such as tax loss harvesting? So if you have money in a capital asset account or a brokerage account, and when those assets go down, can you sell and buy something similar to start harvesting losses to offset against future gain? And the one that we just talked about is like doing Roth conversions. So there's so many other strategies that you should be thinking about if you have a disciplined approach. Look at Big Al here, right? He got 30% of his money back, and who knows what he was invested in, right? If he had just a simple, low cost, globally diversified allocation, and if he does things appropriately when markets get a little bit scary, he's going to be way ahead if he would have picked the best investment in most cases.
Yeah, absolutely. I mean, it's and that's the thing. Most people think about, I don't even want to think about the market, or they sell, which is a terrible mistake. Right.
But I would say most people sell.
Yeah. I mean, that's what you think about doing. It's like, I can't afford to lose any money. Joe, Al, I'm retired. I don't have that much time. Well, wait a minute. You retired at 62 and life expectancy is into the late 80s.
Right.
You have a lot of time. You need some growth. You need some growth for inflation.
All right. Let's move on. Let's go to, hey guys and gal. My name is Ryan. I'm from Texas. I first want to say I love the show. Great info and very entertaining. I love the wit.
Y'all so witty.
What are you talking about?
See, we're talking about you or me?
I think it's you, Big Al.
Or both?
Yeah. Tax chat with Big Al. I drive a Ford F-150, and I love a good old-fashioned or a cold beer.
Okay.
Ford F-150. I've been contributing the maximum amount to my Roth 401k since it was available, thanks to this Shire.
I think it started with thanks to this year, my wife and I. So I think he might have left out a word or two.
Oh.
Yeah. Just go with year. Thanks to this year.
Roth 401k since it was available. Thanks to this year, my wife and I have some bumps in pay. It will be making $405,000. Oh, we'll be making $405,000 combined. Jointly.
Sounds like a great year.
Sounds like a great year.
Not too many bumps there.
No, big bumps. That puts us at 21,000 into the 32% tax bracket. Should I switch out of a Roth to keep in the lower bracket? My wife will still put hers in the Roth. That leads me to the second question. I max out my 401k, but my wife only takes advantage of the match. Now that we have increased income, should I max hers out or should I begin putting money into a taxable account? Right now, I think I'm on track to hit my 401k goal of $3 million by age 65. That goal obviously be higher if both of us maxed out the 401k each year. Or should I keep my goal where it is and add into a taxable account? Thank you again. All right. 32% tax bracket.
Yeah, only 21,000.
Here's my rule of thumb in savings, Ryan.
Okay.
Fully fund the 401k plan.
Yep.
Right. And then if he can do Roth IRAs, do Roth IRAs. If he can't qualify for Roth IRAs, do backdoor Roth IRAs.
Okay.
So that
If-
means
if you can do backdoors.
yeah, I would imagine Ryan can do a backdoor. Because if he has IRAs, put those IRAs into your existing 401k.
Right.
Then you do a non-deductible IRA contribution, convert those to Roth. Have your wife fully fund, max it out. If she's doing Roth, fine. Have her do Roth. She probably should do pre-tax if I was Big Al. I don't know how old Ryan is, though.
I don't either. Yeah, that would be
If
helpful.
he was in his 40s, 30s, or 40s, I would say probably do Roth. If he's in his mid-50s, getting closer to 65, maybe pre-tax at the 32% bracket.
Yeah, I'm right with you. I think if you're near retirement, 32% bracket, I don't really like, right? So I would actually 21,000 is what you're saying. You're into the 32% bracket. Maybe do that as a traditional to get to the top of the 24. If you're younger, then chances are your income is only going to go up. Tax rates are probably going to go up. So why not just max out the Roth, do it, and forget about it?
Yeah. So max out 401ks, go to backdoor Roth IRAs. And then after that, I would do the mega backdoor. So do you have an after-tax component in the 401k plans? If you do, I would take full advantage of that and convert those to Roths. And then from there, I would start building up the brokerage account.
Yep, makes sense.
$400,000 a year.
A lot to work with.
Yeah, a lot of work
Yeah.
up there.
Yeah. And if you think about it this way, anytime you have a choice, right? If you're going to retire at 65, it appears, based upon what you told us. Anytime you have a choice, would you rather have money in a Roth IRA, which is fully available at 65, or a brokerage account, which you have to pay taxes on? Well, the answer is easy. I'd rather have a Roth than a brokerage account.
Yep, 100%.
Now, if you need the money before you retire, that's different, right? If you need the money before you retire, like for another house or vacation home or something that, kids' college, well, that's different. Then put some money in the brokerage account if you have a need for it. Otherwise, try to get the money into the Roth. You'll be happy.
All right, moving on. Veronica? What the hell is this?
I believe it's just
Weeba?
pronounced Veronica. But it's
What?
Polish. It's Polish, so it starts with a W, but it's pronounced Veronica.
Let's say Veronica.
Oh, really? I've never seen Veronica spelt with a W.
Well, the traditional Hawaiians say Hawaii.
Yep.
So it's with a V, the W's a V. So that's the same concept here.
Okay.
Joe's learning something new every day.
I mean, this show. It's
It's
just
just
a
a-
gift that just keeps
It's
giving.
just amazing. And that's why you want to get out of here.
Oh, man. Don't even go there. Let's go.
Oh, you love it. You're going to be here forever.
Yeah, forever's 2 years. I'm 43 years old. My husband's 55. We live in Texas. No kids. Drink of choice is buttery Chardonnay for me, bourbon for my husband. We're looking to retire in 1 to 2 years, move to Europe, and anticipate annual expenses of less than $120,000. What adjustments to my savings investments should I make, if any? We are currently in the top bracket. We have no debt, including no mortgage on a house of $1 million. I have the following: $2.3 million, $260 in cash, $700 in a 401k, $100,000 in a Roth 401k, and $1.2 million in a brokerage account. I have 50% of my salary that maxes out the 401k, 12% after tax pay, and 50% annual bonus goes to the Roth IRA. All right. My husband has an additional $4.5 million of savings and investments.
Okay, I think
Hey, Veronica.
you're doing
I
pretty
think
well.
You're doing pretty good.
Check.
Should I try to put as much as possible between now and retirement into a backdoor Roth IRA? Right now, I plan to contribute $80,000 a year versus non-Roth investment accounts. I still plan on maxing out the 401k to the employer match. When we retire, we anticipate dropping to the lower bracket. Should I or my husband convert part of the 401k? Okay, so you got a lot of stuff going on here, Veronica. You're 43 years old. Your husband's 55. So you got $2.5 million. Your husband has $4.5 million.
And she mentions he does not have any Roth at all right now.
Okay.
Yep.
And so you're making good income. Where should the money go? I think it's the same strategy that we just talked about.
Yeah.
I would fully fund your 401k plan. I would do after-tax contributions if they allowed and do the conversion. And then I would do backdoor Roth IRA contributions all day, every day. So,
And then, yeah, go ahead and do the Roth conversions. When you retire, you'll be in a lower bracket. Should you go to the top of the 22% bracket or 24? Well, we don't know how much your husband has in deferred accounts, but based upon the total assets that you have, it would likely be beneficial to go to the top of the 24% bracket. It's a good bracket. We don't know how much longer it's going to be around. You appear to have resources to pay the taxes, so that would be a really good thing, but not when you're in the highest tax bracket, right?
yeah, you're going to spend $120,000 a year, and you're going to have $4, $5, $6, $7, $8 million.
Yeah, going to be a lot of income, a lot of taxes on money you don't need.
Yeah, I would get as much money into the Roth IRA as possible. What tax bracket are they in right now?
They're in the top.
Top, so 32.
37.
37%
sorry, 37.
tax bracket?
Yeah.
I forgot there was a 37.
Yes, there's a 37. Yeah, that's why I would do Roth conversions after they retire.
Yeah. So, but fully fund the 401k plans. If there's after tax, do the after tax, do the back door, and then everything else funnel into the brokerage account.
Yeah, me personally, I would do the traditional 401k instead of any Roth component, but I'd fund the after tax component, just like you said, so you can put that directly into the Roth, right? So that can be a good way to go. The highest tax bracket, though, you kind of want to get a tax deduction now, I would say.
Are you ready for retirement? Are you prepared? Are you nervous? How you prepare in the last few years before you retire will greatly impact what kind of retirement lifestyle you'll enjoy. This week on a brand new episode of Your Money, Your Wealth TV, Joe Anderson CFP and Big Al Clopine CPA count you down to retirement with the must-do preparations that'll get you ready to punch the clock for the final time. Watch the last 5 years before retirement will decide your lifestyle. Here's how on YMYW TV. Then calculate your free financial blueprint to see if you're on track for the big day financially. Just input your income and savings, investments and debt, and your expenses and goals. The financial blueprint tool will analyze your current cash flow, your assets, and your projected spending for retirement, and output a detailed report outlining what you can do now to help you achieve those retirement goals. Minimize stress, maximize life, and prepare for the future. To start taking control of your retirement, just click the financial blueprint link in the episode description.
Hello, Andy, Joe, Big Al. This is Jerry from Phoenix. Looking for a little spitball response on whether there is a logical point where no additional Roth conversion makes sense. Actually, this is really my attempt to see if Joe would ever come to the conclusion. Yes, I come to that conclusion all the time.
I've heard it on the show.
I drive a 2021 BMW 430i. But my backup is a 1997 Tacoma. I used to take the dog to the dog park and go hiking in South Mountain Park in Phoenix. You ever been to South Mountain Park?
I don't believe so. I'm not sure I know where it is.
I've never heard of it. My wife and I both retired about 5 years ago, and we were 67. Our current balances are about $7 million after tax. Oh, boy. Way to go, Big Jer.
Here we go.
$3.5 million in an IRA, $950,000 in a Roth. While I'm not concerned about having enough assets to live on, I'm trying to make sure I maximize our lifetime tax bill and minimizing the taxable IRA balances so that our two sons that will inherit will get killed in taxes. I started doing Roth conversions about 4 years ago and plan to continue converting about $200,000 a year for the next 6 years until my RMDs begin. For 2025, I've already done $90,000 in conversions. I've heard several financial podcasts refer to and sort of endorse a software package for financial tax planning called Bolden, formerly New Retirement. Well, yeah.
We know about New
Steve Chen.
Retirement. Yep. I met Steve Chen years ago.
Yeah, love the guy. Great company.
Yeah.
I've acquired this software, and for the past 3 weeks, I've updated the software to include all assets, income sources, planned expenditures, assumed 2017 tax rates, etc. After reviewing the results and recommendations, I have to admit I am very surprised by the results. Per this software, the advice is to do no further Roth conversions. The software believes this approach will minimize my lifetime tax bill, federal and state, and provide the largest estate value. Obviously, the software doesn't know the tax brackets of my heirs and what the future tax rates will be. I was just expecting the no additional Roth recommendation. What do you
Was
guys
not
think?
expecting. Yeah.
Okay, Jerry's 67 years old. So
Yeah.
we're missing a few important facts here. Jerry, I don't know what your income is. You're
Yeah.
doing $200,000 conversions. I have no idea what bracket you're getting yourself into.
Right. Yeah, we we don't know how much your fixed income is, what your tax bracket is. See, that would be helpful to know because whether you do a Roth conversion or not is dependent upon your age, how much you have, and how much you're spending. Not only how much you have in a IRA 401k, how much you have in a Roth, how much you have in a non-retirement account. Then we can sort of decide or help you with whether that's a good decision or not.
Yeah, here's what you have to look at. Sometimes those you have to be very, very careful. And no offense to New Retirement or Bolden, we use that. We offer that software for
Yeah.
free to our listeners. You can
It's a
go
good
to
good program. Yeah.
EasyRetirement.com.
Yeah.
I don't
It's
know if it's
EASI.
EASI. That's why no one ever went to the website.
We don't know how to
Because
spell it.
It's not. It's like, yeah, I went to Easy. Well, no,
There's nothing there.
there's nothing there.
It says
Yeah,
you can have this website if you want it.
it's EASI.com.
Yeah.
EASI at retirement.com.
Yeah, okay. I don't even know what the hell. The
You don't even
website-
know the website.
Yeah, we get 4 visitors a year by accident,
Just listen to Annie. She knows the website.
and so I don't even know what I was talking. Okay, no, financial planning software.
Why not
is
to pay
dangerous.
attention to easyretirement.com?
You got to be careful with financial planning software, right? We use it every day, and it's looking at a snapshot in time that day. I can guarantee you this, Jerry. Everything else that you see in the future is wrong. You have no idea what markets are going to do. You have no idea what inflation's going to do. We have no idea what tax rates are going to do. We have no idea what your life is going to bring. Right. So when you're like, here, let me plan this out from age 67 to 97 or to age 100, and then you look at the tax savings number, and that computer software is going to be like, yep, no conversions. You're like, all right, I'm done. No, you don't want to necessarily do that. You have to take a look at this stuff every single year. And also the rate of return that you're running on the investments. You're using a hypothetical, let's say 6% growth rate. Well, if you do a straight line 6% growth rate, it's going to be apples to apples. It's really hard to really make decisions long term if you're looking at it that way. You have to look at it and make decisions every year and update the numbers every single year.
Yeah, because one of the things that happens here is when you have these programs, they'll generally have a fixed tax rate, right? So and so that's why it doesn't necessarily make sense because you're going to be in different tax brackets. You're in a higher tax bracket often when you're working. You retire before your RMDs, before Social Security. You're in a much lower bracket. You want to do Roth conversions to take advantage of that. Maybe you're already receiving Social Security, but it's ahead of required minimum distributions. Right now, the tax rates are pretty low. So it may make sense to go ahead and do a conversion. Also, these programs assume that you're both going to live forever. One of you will probably outlive the other, and you get into the single rates, and it's completely different tax rates. So just be careful when you're kind of looking at a program. This is a good program, but you're looking at a program with only so many variables, and you're making long-term conclusions on that.
$3.5 million. He's got a retirement account. He's 67 years old.
Yeah, it's
So-
it's going to be 5 or 6 million at RMD age.
Right. Well,
He'll be I think he's 73.
Okay.
Yeah, so he'd get it 70. So it's got
I would
6
say
years
four.
from now.
Let's say it's $4 million.
Yeah, just go 4.
So $160,000 RMD. I don't know what his other fixed income sources are. So just kind of think of it that way. It's like, all right, well, what tax bracket am I going to be in when the RMDs hit?
Right.
Am I going to be in the 24, the 22?
And compare it to today.
To today, I
Yeah.
would convert to the same bracket that I'm in today. So if I'm in the 24% tax bracket, because you have plenty of assets, like he
Right.
said, and he wants to maximize the amount of dollars that is going to go to his 2 kids. So what tax bracket are the kids in? Because once they inherit the retirement accounts, it's IRD, income respect to the decedent. They have to take the money out and pay ordinary income tax on that.
Yeah, over 10 years. And they may be in a high bracket, and that would be a lot of money to take out in 10 years.
Right. If it's in a Roth, it's 100% tax free, and there's no RMDs in a Roth IRA. Right. So it's like, all right, well, here, can I continue to convert this thing that's going to reduce my RMD? If I pass before my spouse, the RMD for her is going to be the same RMD that you're taking roughly, but now it's at a single tax bracket.
Right.
So there's all sorts of things to consider. At $3.5 million in retirement accounts with no need for the money at 67, I don't know. I just still, unless you got a $200,000 pension, I don't know what's going on.
Yeah, unless you're in the highest bracket somehow.
Yeah, if you're like converting in the 32% tax bracket or
Yeah,
something
I
like
wouldn't
that.
do that.
I wouldn't
Yeah,
do that either.
right.
But yeah, Jerry, congratulations on the amount of wealth that you have. Congratulations on being an engineer and going to all these different websites and trying to figure out the most optimal Roth conversion possible. But just like with anything, it's optimal each year. Like the market's down 20%.
Yeah,
I don't care what tax bracket that you're
I'm
in.
doing
You got
it.
$3.5 million. I'm doing a conversion.
because the assets are going to recover in the Roth, and then it hardly matters what bracket you're in. In fact, one way to think about it is you look at what you ended up with in the Roth by the time you have to pay the tax, right? And compare it to the tax you paid. That'll actually be probably a pretty low rate if the market zooms right up.
You look at asset location. Usually, if you have a strategy, an investment management strategy, you have asset classes that have a higher expected rate of return in your Roth IRA.
Right.
Because you'll never pay taxes on it. I don't want to have bonds and cash and CDs in my Roth.
No, you don't get rewarded for that growth because there's no tax to pay in a Roth. So why wouldn't you want your stock?
Gas on there, right?
Yeah, but load it up.
We want some firecrackers in there. And so if you look at that, all right, so now I have more stocks that have a higher expected rate of return in my Roth. So maybe they have an average rate of return that is higher than the S&P 500 or a globally diversified portfolio. So there's so many other things, that you have to consider. But here's the other thing that you don't want to do a Roth conversion on. If you don't have the cash to pay the tax, don't do it.
Yeah.
Let's say if you're going to now pay more tax on your Social Security, probably doesn't make sense. Where we've seen people that have very little tax on their Social Security because it's based on provisional income. And all of a sudden you do a Roth conversion, it's like, now all of a sudden more of my Social Security is subject to income tax, and it just pops them up into a higher bracket. There's IRMA, right? So if you're going to go into a higher IRMA, you might want to consider maybe not doing that. You have to run the numbers there. There could be credits that you're giving up.
Yeah, educational credits. You could own rental properties, right? And you get a $25,000 deduction, but with that Roth conversion, that goes away. You converted $50,000, but all of a sudden you have to pay tax on $75,000 more dollars. That's not a good deal.
Yeah, we saw someone wanted to get out of individual stocks, so they sold X amount of dollars out of the stock. Oh, and then they did a Roth conversion on top of that, and then now that capital gains is subject to net investment income tax.
Yeah.
Probably don't want to do that. If I want to look at diversifying from a stock and be in that 0% capital gains rate, I probably don't want to do a conversion. See, Jerry? Look at that. That's like 10 things that you don't want to do a Roth conversion. What else do I got for? How about the Affordable Care Act? Oh, I need my.
Oh boy, that's actually a pretty big one.
This is starting to remind me of that scene from Roxanne where Steve Martin starts listing all of the insults for his having of a big nose. You know that scene that I'm talking about, right, Joe?
Yeah, that is good.
You're starting to reel off all the reasons that somebody should not do a Roth conversion because, dang it, that's what you're known for is the Roths.
All right. Well,
Okay.
Well, but I still think Jerry should probably do it.
I do too, but we need a little more information.
All right, Andy, this is what the last show you're going to do here in the stateside.
Well, that depends. I think there might be one more.
Oh.
It sounds like Al and I might be recording one more.
Yeah, I'll do one with you next week. We'll do Social Security.
Sounds good. So yes, that will be my last one. This is the last one with all three of us together.
Got it. Alan wants to do some Social Security talk.
I can't wait.
Little Social Security chat.
So yes, Social Security chat.
Got it. There you go.
Well, it was fun again,
Yes, sir.
as usual. Good job, Joe.
Great job, Big Al.
Yeah, and Andy.
Yeah.
Thank you. Your Money, Your Wealth is your podcast. If you enjoy it, do us a favor and tell your friends. That helps us reach more listeners like you. And don't forget to leave your honest reviews, comments, and ratings for Your Money, Your Wealth in Apple Podcasts, on YouTube, and in all the other apps that let you do that. Your Money, Your Wealth is presented by Pure Financial Advisors. Learn how to make the most of your money and your wealth in retirement. It takes more than a spitball. You can schedule a no-cost, no-obligation, comprehensive financial assessment with the experienced professional on Joe and Big Al's team at Pure. Just like a spitball, it is free. Click or tap the free financial assessment link in the episode description or call 888-994-6257 to book yours. You can meet in person at any of our locations nationwide, or you can meet online right from home. No matter where you are, the Pure team will work with you to create a detailed plan that's tailored to meet your needs and goals in retirement. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.